Ladies and gentlemen, at this time we are going to have a trader profile segment, and this will be a series in which you will be able to either be introduced or reintroduced to pieces of our trading team, and we will have one every day around this time. Today we're going to focus on Chart Trader. This is a guy who's been trading professionally since the late 1990s. He started out with more of an equities focus, but has shifted more into the macro or futures trading aspect from around 2010 or so, and has made a gradual transition into more of a macro-related trading strategy. He relies heavily on technical patterns, sentiment data, economic data, and takes a bird's eye view of fundamental trends. And with that said, I'm going to bring in Brett Manning, aka Chart Trader. How are you?
Doing pretty good, Jim. How you doing?
I'm doing quite well, Brett. And so, in the context of introducing yourself, we kind of went through some of the different aspects that you have done, your background and whatnot, but you really do gauge the market in two different types of activity levels. Sometimes you're more aggressive and sometimes you ease off. What's the real difference between those two components?
Well, so I focus on both all the time, and I guess the way that I present it here is maybe a little bit misleading, as if it's one or the other. But really, the big swing factor is whether or not we're seeing what I would call serial correlation, which is something that we get in emotional markets when there's a great deal of volatility. The tape is easier to read, patterns are more determinate, people herd, and a dynamic like that is easy to take advantage of if you're experienced and used to dealing with markets like that. But in a different market context, when those sorts of opportunities aren't as easy, it is possible to only take advantage of what's really easy and what the market is giving you. So I've structured my approach around the idea, based on experience, that you can do really well, but you can also really shoot yourself in the foot by being overly aggressive in intraday trading during periods where the market is choppy, where volatility is lower, where the market is more quiet. So all along the way, I'm also basically trying to hunt big macro trading opportunities where the short-term trading is tape reading, it's pattern reading, it's overall bias. The big macro opportunities are larger time frame and based on what I would call next world views, around the corner views, and we'll get into some of the structure of those sorts of setups in a few minutes, but sentiment data plays in, pattern structure plays in, market fundamentals plays in, economic and macro catalyst plays in. So it's really two totally different kinds of approaches. But the next point would be, well, so what defines good volatility versus difficult volatility? And I think we just had an excellent example of that in mid to late September and very early October. We had what I would call bad volatility. Basically, that the market needs new breaking headlines every couple minutes to sustain a VIX above 18 or 20, that the volatility is about a binary outcome event that's still in front of us. That I would call bad volatility. That's something you can get sucked into trying to trade, but you're going to have very difficult time keeping conviction. Good volatility is when you got a VIX above 18 or 20. Maybe it's set off by an original headline, like something we had in late July or in late April. But once that volatility starts, once that emotional market behavior starts, you have a kind of game theory landscape where patterns resolve relatively cleanly, you get strong follow-through, and it's not all about just guessing at what some announcement is about to be in a couple days. So otherwise, you know, the larger time frame plays, the larger macro strategies really come down to hunting what I would call elephants, where you're picking up clues throughout the day. So when there's not a lot of intraday trading energy, you still have the job as a professional trader to track the market and to pick up clues, to find that broken twig, to find that tree trunk with missing bark, to see where the elephant is going. So you're picking up on where that next big opportunity was or is going to be. And in June was a good example of when both were happening. I had a lot of intraday trading going on, but also that's when we got the main leg of the big gold position, which we'll talk about in a few minutes.
All right, Brett, you had highlighted quote-unquote good volatility, and with that good volatility, you also have good setups. What is the structure of a good setup in your mind?
So I mean, you see a list of the 5 key elements that I think are really important. The first one, falsifiability, is probably the most important consideration. And I think a lot of traders overlook this. Knowing precisely what it is that would make you wrong on an opportunity is really the most important thing to know. If you don't know that, let's put it this way. If you don't know what will make you wrong on something, you have the potential for a catastrophic loss. If, for instance, if something's gone down too far and you buy it simply because it's gone down too far, well, then every tick further that it goes down theoretically makes it even a better setup, right? So you never really know when it's become a falsified setup. So if you start out with setups that just logically can't be falsified by anything the market is going to do, then you open the door for the possibility of a catastrophic loss. And doing something like that, fading something that's gone up too much, buying something that's gone down too much, are prime examples of how people really blow themselves up. Thematic logic is really about being able to see what's around the corner, being able to understand what the next world might look like, and I've got a prime example to show you that I just published in my chart book for that kind of thinking. And the larger pattern and mode being on the right side of the trend and the mode of the market. Every market's got a mode of behavior. If you study markets, if you watch markets as obsessively as I have over the years, you get a sense that there's certain behavioral aspects, like personality aspects, that are consonant with being in an uptrend, being in a downtrend, being in a relatively unproductive range. You can start to pick up on clues above and beyond just looking at where it is relative to a moving average. You're noticing it in the tape. You're understanding the types of ways that it responds to certain headlines, that it responds to certain patterns. It's a mode. It's a personality characteristic, and every market has multiple personality disorder. It has different ways of exhibiting different types of behaviors in different trend contexts. So being able to recognize that and always being able to structure your strategy in line with that. And then also, it's not good to be on the same bus as a big crowd that's all betting on the same thing that you are. So being really keen on the sentiment situation is important. You want to find relatively contrarian opportunities. By that I mean where you are seeing a situation where it's in a relative context, it's contrarian. It doesn't need to be deeply contrarian. For instance, in an uptrend that's been dominated by exuberant sentiment, when you get a pullback, if the pullback is a strong pullback in sentiment relative to the pullback in the market, you see an opportunity on the long side to bet for that next leg. So relative to the sentiment context, tracking both. And then the pattern dynamic on a smaller time frame is also important. You just need to get into the habit of understanding the different types of setups and triggers that you really feel comfortable with. And so when you have the bias from these other 4 elements, and you can also play into where the short-term technical trigger is that really sets off when the horse is leaving the barn, is important.
All right, Brett, and what would you say is the best way for listeners to get a really thorough gauge on the sentiment readings?
So sentiment readings, I publish every day obsessively. I look at options data. I look at sentiment surveys, money flows, a number of different elements. We also have a show that Gavin and I do. Gavin is Event Trader. Every Tuesday at 2:30 Eastern, called the Sentiment and Flow Show, where every week we cover basically where everything is in terms of basic sentiment data, looking at the robo ratio, average put call, looking at money flows into equities, into bonds, into other areas, looking at fund manager surveys, looking at AAII data, investors intelligence, everything across the board to get kind of an overall construct that says here's where people believe is going to happen. And it can be about other issues besides market direction, like the likelihood of inflation, for instance, which we'll talk about as well.
All right. Now, why don't we break into a good example of one of the trades? And I think this would probably fall into the elephant hunting category. That gold long that you had earlier this year, you initially got involved in it I think it was really early in the year, and it didn't quite work out, but you kept the faith, you kept the theme going, and you were able to take advantage of it. So let's walk through this gold trade.
Yeah, so it was the previous August that I initially got involved.
Oh, okay.
But yeah, then it was again in April. The basic idea here was I believed that gold would be the best way to play a second derivative economic data comp weakness. So in the shadow of the burst that we had off the tax stimulus in early 2018, everybody's losing faith in monetary policy as a single pillar. and that really opens the door for fear of what I would call policy experimentation. And we saw that, I think, or at least rumors of it with modern monetary theory and a lot of the everything that we're seeing with central bankers all asking for fiscal stimulus, trying to find some way that they don't have to support everything on their own. This is obvious around the world when you look at Europe and Japan. We have $14 trillion, I believe, now in negative interest rate territory. So, and it was also a really strong weekly chart, bullish ascending triangle, and in what I call the D leg, if you think of A, B, C, D, E, right before that breakout leg, and it was kind of in the pocket of that. And so there was the initial GLD position, and once we got the Fed indicating the rate cut was coming, the following report, it was obvious gold was just headed for the breakout level. And, that was the time to put on the futures position as well. That got us to about 150% size in it, and it just went through the roof. So if you want to show the chart, that should be...
Yes, I do have it up. And the green arrows represent where he entered
Those
the
are
trade,
entries.
and then the red arrows, of course, would be the exits. And you time that exit, that last one, really, really well. And I think
dead at the top, yeah.
Yeah, and you were able to do that because you kind of scaled out of it. So you were able to maintain that position, and you do a lot of that scaling out of it, looking for inside targets, and then an extension. And you nailed this one really, really well.
Yes. So it worked out fantastically well. And you could see the really large time frame pattern trigger there with the. I mean, that's a huge ascending triangle that came to a head, and that was something that really makes it easy to have confidence, especially when you get that D leg, you get that E leg banging up into that trend line. That's when we added to it, and it was the perfect time to add to it. You're going to get some kind of follow through on a breakout above a line like that top dotted line, and it just really took off.
And this is also on a weekly chart, and you don't tend to see those very often. You'll see ascending triangles on intraday charts on 5 minutes quite frequently, but the fact that it was on a weekly probably gave you even more confidence.
Yeah, certainly. There's no way that those orders aren't gonna flow through and cascade.
Okay, and before we get into your chart book, you did provide this graph that shows a correlation between your trading and where the VIX is, and how that kind of translates into how aggressive you are in your day trading patterns.
Yeah, right. So this gives you a sense of the types of periods that are the most dramatically successful for intraday trading. And you can see, obviously, October through early January was just an extraordinarily special time. And in late April, early May, and into June, and throughout that period of positioning for the gold trade, there was a lot of intraday trades, a lot of intraday opportunities. That was a tremendously successful period. And then again in very late July, when we got the warnings about the re-escalation of the trade war, we got a headline that drove it. But in the aftermath of it, you can see that each one of the spikes that I've highlighted there in the VIX, they have a kind of sense of a sort of infinite spike potential as they go. They're not contained. They got these huge tails at the top, and people really are forced to position themselves for the possibility of taking out truly catastrophic risk insurance. And the most recent move that we had above 20 is totally different character, and that's because it was preceding the headlines, the binary outcome headlines, on what is now understood as the Phase 1 trade deal.
Right. And another thing that I think this represents is a good example to show that you don't have to trade every single day, because it does represent enough time in which you can capitalize on the quote-unquote good trading times.
The easy markets. Exactly right.
Right. And so there's a lot to be said for, remaining solvent, not only from a monetary standpoint, but your own emotional standpoint as well. So that's a good gauge. But it looks like the magic number is VIX above 15 with an asterisk, right?
Yeah, basically. Like I think in terms of a close above 1750 or so, I really like a close above 2250 and then reverse the idea on a close above below 1750. But yes, I mean in this type of market environment that we've seen for the last several years, where we've got a lot of periods of a depressed VIX, then yeah, I mean when you get above 15, you've usually got something going on, and it picks up.
Oh geez, if the VIX was above 22, it'd be Christmas every day here, Brett.
It will happen, Jim. Christmas will come.
Yeah. All right, my man. So I do want to touch on your chart book, and let everyone know that this is something that you put out once a month, every 6 weeks or so, that has a lot of
Roughly, yeah.
thematic concepts to it as it relates to the different markets. So you come out with a theme, and then you talk about how the different markets can respond to it. You give some pros, cons, different scenarios that set up. And in this one, you just posted it this morning, is that correct?
That's correct.
All right, so it's hot off the press. And there were a couple of things that you definitely wanted to touch on here. And the potential for a breakout that you think is on the verge of beginning. Do you want to touch on that real quick?
Yeah, so I think there's a lot of red flags on a longer-term time frame. I think we also have a sort of game theory landscape set up that can allow a kind of breakup. I think or breakout to the upside. I think technicals are clear, showing the bullish ascending triangle in the S&P, and the fact that we have sentiment data landscape that's been very skeptical and has now moved back into neutral territory has the possibility of overshooting in a bullish direction. And the fact that I believe personally, as I wrote in my ETF daily notes this morning, that we have a political landscape where we have a definite incentivization, in my opinion, for the White House to begin to paint a picture that moves leading indicators back up to try to juice up economic strength, particularly in economic sentiment data, ahead of the election. So basically, the PMIs, the ISM, the Philly Fed number, consumer confidence, etc. And they could do that, I think, with rhetoric around the trade war and basically really trying to paint a picture that we're on track for resolving the trade war, and that the White House, whether the market buys that or not, is on track for possibly even reducing tariffs, not just eliminating the December tariffs. And there's a sentiment chart at the bottom of the set of sentiment charts showing hedge fund exposure, which shows that their exposure tends to spike over the last year or two anytime we make a slightly new high in the S&P. You see this huge rush of hedge fund money coming in, and I think that's this chart is based on the relationship between the tracking index for hedge fund performance and the S&P, and when you see them come into alignment on a day-to-day basis, the hedge funds are basically in equities on the long side. And you see that spike up anytime the market moves out, and I think that is essentially a hedge, so that when we get the breakout, we could get the follow-through if we move above the top line of the S&P right now, basically because hedge funds are not very exposed to this market, and they move in. So I think we get fuel if we also get the White House trying to play ball with that.
All right. And then you also articulated a potential black swan inflationary event. Is that the best way to describe it? I know you summed it up in this segment, or the section that says the leaning the wrong basket, or the leaning wrong basket. Sorry about that. And you highlighted this one on the Sentiment and Flow show. And just in case anyone missed it, why don't you just give us a little snapshot of what you mean by that?
Yeah, so I think that when you think about thinking around the next corner, we talked about the 5 elements of a good setup. That second one, when you're thinking around the next corner, you're taking a world where there are obvious assumptions in place, and you've got to think in terms of a what-if scenario. What if some of those assumptions are wrong, particularly when you see a situation where there's a sort of black swan arrangement. In other words, everybody is all in a consensus fashion on board with the same basic assumption. That may be the case because that assumption is totally right. It's possible that that's why, obviously gravity, for instance, is not going to turn off tomorrow. Everybody believes that. But imagine the world that we would face if gravity shut off tomorrow, right? It would be a huge change. So just thinking in terms of when you see interesting consensus expectations form in a market, then there's consequences if everybody turns out to be wrong. And right now, there's a dramatic version of that. There's a number of different data points that show that there's an intense lack of appreciation for the potential of inflationary growth from here. So strong growth on rising inflation. It probably is a correct assumption, but part of that is because people don't believe that central banks, through monetary policy alone, have the ability to really push things at this point, and part of it is because we're seeing economic deterioration. But the result is that in the latest Bank of America Merrill Lynch fund manager survey, just 4% out of 200 and something large fund managers believed inflation would pick up over the next year. And we see bond markets pricing in no inflationary risk, with the 10-year recently banging back into that 1.5 level. We see one of the, as of the last couple of months, the largest ever speculative short position in copper futures. These are all kind of signs of that same sense of an intense consensus assumption that inflationary growth is essentially impossible. So the leaning wrong basket is the idea that you need to appreciate when there's that consensus there, and then have on your radar, because if we start to see signals that all of that is wrong, then there's going to be some huge market moves. That's when you get the biggest and most important market moves, is when a highly consensus position is wrong.
And what would be the key indicators that would give you a sense that that is underway?
I would say the PCE coming up from the Fed will be important, but the CPI we just got was 2.4% above the Fed's target range, but also market behavior, seeing bonds sell off a little bit more than they should. If we get, and my number one scenario for this would be that the White House does precisely what we talked about before. If we start to see rhetoric from the White House really try to get purchasing managers in the industrial and supply chain and logistics sector back excited about the economy. We've seen a lot of hard data about the economy in terms of retail sales, employment data, consumer confidence, etc., hold up pretty well, but we haven't seen the more sentiment side, and particularly the side related to logistics, supply chain, manufacturing, that's really broken down. If it's possible that the markets begin to sense that the White House agenda is to juice that side of things into the election and really peel back on the difficult and contentious rhetoric with China, then it's possible there's been a pent-up demand situation where people have involved in packing the supply chain have failed to really keep up with the demand that may be in front of them because they've been skeptical about it. They suddenly have to make up for lost time, and you see a pop in terms of heavy industry, in terms of industrials, in terms of transports. All of that would be something that would fuel that kind of energy in the markets and that kind of inflationary growth theme. So I think that those would be clues. And then, of course, market behavior, how copper starts to behave with this big short position, how emerging markets start to behave.
All right, Brett. I think that gives us a really good glimpse into some of the things that you look at, and of course, we'll have you back on from time to time, and you can always give us a read on what you're seeing, especially when things are changing. And you do a very good job on the page of doing that. You come on and explain your case very well. And then one other thing that you do very well is you answer a lot of the listeners' questions. And the best way to get an answer from Brett is to leave your email. But he's also courteous enough to many times post it on the page if he thinks it's a very relevant question that others may have. So, Brett, with all that said, I want to thank you so much for doing this little presentation with me and spending some time giving the listeners some perspective as to how you go about your trading day.
You got it. Thank you very much, Jim.
Hey, absolutely. Thank you, Brett.